Hi guys, welcome to the video on income statements, which is chapter 8 of our textbook, and it covers pages 118 to 124. What are we going to cover in our learning intentions? By the end of this video, you can hopefully say that you have achieved or understand these four things. You understand the definition of revenue and expenses. You can identify transactions that are revenue and expenses. You can understand the difference between cash and profit, and you can understand how you might prepare an income statement. If you then use this resource to make great notes, do all the exercises that are set, you should have a successful unit and leave saying that you can achieve the success criteria because you have completed an income statement, you have transferred profit and loss to a balance sheet, and you can analyze a business's profitability by looking at an income statement. Before we go on, probably just to get an understanding, this chapter 8, links a little bit to chapter 7, which was on statements of receipts and payments and cash flow. So if you have skipped that part, I would encourage you to look at that before we get to this, because I will be talking about content from chapter 7 and in particular the video of chapter 7. So what do I mean by an income statement? It is, as I said, it's important to distinguish between an income statement and the statement of receipts and payments, because a statement of receipts and payments, which we did in chapter 7, reports on cash, whereas an income statement focuses on profit, which is something that you've probably heard of. You've probably heard of the term profit before. You might not have heard of the exact definition that we're going to use under the accrual assumption of Year 11 accounting. The definition that we are going to use is that profit is revenue earned less expenses incurred. So we need to have a good understanding of what revenues are and what expenses are, because you simply add up all your revenues and subtract all your expenses to come up with profit. So for example, simple example, if I have a business that makes $100 of revenue, so $100 of sales, but I have $80 of expenses in the course of that business, I've made $20 of profit. And I think we all probably understand that concept or heard of that before. So let's have a look at an income statement. Here is a typical income statement. You might even recognize this business from chapter 7. I want you to have a good look at that income statement and pause the video and think, what do you notice about this income statement? So pause the video now, have a good look, what do you notice? Now that you've come back, what are some of the things that you should notice? You should notice at the top of the income statement there is some important information. It says the business name, the report that it is, the month that the report is for, and for how long. So in this case, the business is Jack Rio. We know it's an income statement. It is for 1 month of the business, and it is ended 30th September. So this is the income statement for Jack Rio for the month of September. You also hopefully have noticed that there is 3 sections to the income statement. The first section is we list all the revenues of the business. In this case, it is $4,100 of revenue, and there were 3 types or sales. The expenses are then listed next, the second section of the income statement, and there are 4 expenses, and they total $2,950. Timber, wages, advertising, and insurance being the 4. We know now that the definition of profit is revenue minus expenses, so that's our third section. Our profit is $1,150. 4,100 minus 2,950 equals 1,150. What do we also notice? If we have more than one revenue or more than one expense, we write the individual numbers in the first column and then the totals in the right column. So we know what an income statement looks like. We don't necessarily know how to make one yet. We know that there's a definition of profit called revenue less expenses, and we know that revenue and expenses are in our income statement. What we don't yet know is what really is revenue and what really is an expense. Revenue has 3 main components that all must be ticked off So it is not revenue unless all three of these things occur. The three things are: there must be an inflow of an economic benefit that leads to an increase in sales, that leads to an increase in owner's equity. And it can't be a capital contribution. Capital contributions are never revenue. So all three of these must be ticked off for it to be revenue, and it is quite a technical definition. So the large chunk of the rest of this video goes through some examples for how do we identify whether something is a revenue or an expense. Beg your pardon. But let's use the main example of revenue from the previous income statement, sales. Sales is an inflow of economic benefit. There is a benefit to the business of being a sale. This has led to an increase in an asset. What was that increase in asset? Cash, because you remember this is the same sales that came from the statement of receipts and payments in Chapter 7. And a sale that increases assets increases our business worth, so increases owner's equity. That's why it's revenue. Ticks off all three of those boxes. An expense also has three things that need to be ticked off. They're essentially the opposite of revenue. An expense, for it to be an expense, there must be an outflow or a consumption of a benefit. It must lead to a decrease in assets or an increase in a liability, and a decrease in owner's equity. So if we think about what was one of the major expenses in the previous income statement, wages. Wages is an outflow of benefit from the business because there is an outflow of cash. There is a decrease in an asset here because cash goes down when you pay your wages. And this has led to our business being worth less. So this has ticked off our three technical parts of an expense. And this brings us to an important part of this video, the distinction of cash and profit. These are different measures of performance. Cash in our statements of receipts and payments in Chapter 7 compared cash inflows and outflows. What we are looking at now is profit, which is revenue minus expenses. And the important bit to understand is that they very rarely equal each other. It's very rare that a business will have the same amount of cash increase as profit. Why? Because not all cash inflows and outflows are revenue and expenses, and not all revenue and expenses are inflows or outflows. Some revenue and expenses have nothing to do with cash. Some cash inflows or outflows have nothing to do with revenue and expenses. So, for example, there are a number of cash inflows which are not considered revenue, and there are some revenues that don't result in a cash inflow. Can you think of any of transactions that might be one of those cases? So, a cash inflow that does not result in revenue, or revenue that does not result in a cash inflow. Pause the video, have a think if you can pick some of those transactions that you might have seen in the past. Here are some examples. Cash inflows are typically cash received from clients, and there is cash received by the owner, or we might have a loan from the bank that increases cash. Loans are not revenue though. So it is a cash inflow, but it is not revenue. Cash contributed by the owner is what we can call a capital contribution, and that is not revenue. It is specifically excluded from the definition. Yet there is some revenue in a sale that won't increase our cash, and that's credit sales. So the top one is cash inflows just come from cash received from customers. Revenue comes from cash or credit sales. So this is quite complicated stuff. We'll practice this in transactions and in textbook exercises, but these are some examples. Similarly, there are a number of occasions where there is a cash outflow that doesn't result in an expense, or there are expenses that have nothing to do with cash. Same thing, can you think of any of these transactions? So to repeat it, can you think of any transaction that is a cash outflow that you don't think would be an expense? Or are there any expenses that you can think of that have nothing to do with cash? Here are some examples. Typically, cash outflows are cash paid to suppliers. But yes, if we pay money to our suppliers, that would be an expense, but also we might pay with credit. So cash paid to suppliers is a cash outflow. Expenses in our income statement have not just to do with cash, but they could be on credit as well. Cash withdrawn by the owner, a drawing would be in a cash outflow, but it is never an expense because drawings are not expenses. And loan repayments result in a cash outflow. We're paying back a chunk of our loan. This is not considered an expense in terms of our definition. If we look to summarize all this, here is a summary of cash inflows versus revenues and cash outflows versus expenses. This is quite a complicated part of our unit, part of this chapter, and you'll get a chance to practice this in some transactions. But let's look at our specific example of Jack Del Rio to highlight why there is often a big difference between our profit and our total cash inflow or outflow. And here is our friend Jack Rio again. On the left, you see the income statement for the month. And if you remember chapter 7, and this is why it's important you've done chapter 7 first, here is the statement of receipts and payments for Jack Rio for the same month. There are some things to notice. Hopefully you've noticed that the profit for Jack Rio was $1,150, but the Jack Rio made a lot of cash in this month. Their excess of receipts over payments was $11,950. So there is a big difference between the cash increase versus the profit. In fact, it's over $10,000, $10,800 to be exact. So what are the differences? I want you to pause this video and try and identify at least 4 differences between the income statement and the statement of receipts and payments. Now that you've paused, let's identify them. In fact, there were 6. And the highlighted 6 are here. These are ones that are included in our statements of receipts and payments, but do not end up in our income statement. What does that mean? These are receipts or inflows that are not revenue, or these are payments or outflows that are not expenses. Why? Because they don't tick off all 3 components of the test to be revenue or an expense. So let's go through why. And we'll go through this quickly. This would be a good one to pause to reread and update your notes. Capital contribution, $9,000 of cash was received due to capital contribution. This isn't revenue though, because it's a contribution of an asset by an owner. There's a specific definition in our revenue that says capital contribution is not revenue. Our cash also went up by $3,000 for a loan. But this doesn't represent an inflow of an economic resource that increases owners' equity. It doesn't tick off the 3rd part of revenue. Why? When cash goes up because of the loan, our business is not worth more. It goes up because of our liabilities going up. So our balance sheet balances without anything to do with owners' equity. Drawings, our 3rd one, is not an expense because there's a specific part of the definition that says drawings are not expenses. And purchases of assets are not an expense because there is no change to owner's equity. We have purchased an asset with cash, so our cash goes down. Our owner's equity doesn't go down because our other asset goes up. And finally, GST, whether it's paid or received, has nothing to do with revenue, expenses, or profit because we are purely just collecting it to give it to the government. So again, lots of information here. You'll need to practice a lot of transactions to get comfortable with working out what's revenue expenses, but these are some common tricks. Once we are confident with our profit, and we could have a profit, we could have a loss, we need to transfer this information to our balance sheet. Because once the balance sheet has been prepared, it's important to remember that a profit brings about a change in owner's equity. Net profit determined should be added to the capital section of our balance sheet. along with any drawings for the period. Let's look at this example where there is a profit. In this case, we had a business that was worth $100,000. This business made $20,000 in this period, so it is worth $20,000 more to the business owner. We have to add that to the owner's equity section of our balance sheet to say it is worth $120,000. There has been some drawings, though, in this case, which also go in our balance sheet, and this is a reduction in our owner's equity section. So our balance sheet owner's equity section starts to have a few more line items. Similarly, if we make a loss, this will decrease the amount that the business is worth. So we reduce the capital of our business in our owner's equity section. So capital again started at $100,000, but we have made a loss of $10,000. So our business is now worth $90,000, and there is still the drawings. If we think about our old friend Jack Rio, you can see that we did make a profit of $1,150, and this gets transferred into our owner's equity section of our balance sheet on the right. So the business was worth $9,000 to balance the balance sheet under capital, and then we write plus net profit for $1,150, and then less the drawings. The business is now worth $9,300 to Jack Rio. And this is that $9,300 results in the balancing of the balance sheet. There are a number of accounting assumption and qualitative characteristics that are important for income statements. I'm not going to go through all of these. This would be a good one to pause the video, read through, and then review the textbook, page 118, to get an understanding of these. In summary, though, there are a lot of assumptions and characteristics that are important for income statements. Once we've made our income statement, we've worked out our profit, it is now time to do the hard work of actually evaluating. What the hell does it mean? Because as accountants, we don't just make reports, we give advice to people. The management, or we as accountants, should evaluate the profit, and the ways to evaluate the profit include looking at the trend. Is our profit going up or down across certain months or years? Is it close to what we expected or budgeted it to be? Is it above or below what our competitors, so the industry averages, are getting? And then we might, in year 12, so this is a more year 12 thing, look at something called a financial indicator. Other uses of the income statement is that once we've done this evaluation, it aids decision making, allows us to assess our firm to see if it's meeting its sales targets, allows us to plan for the future if we start to get an understanding of what profit we're making or loss, and also allows us to do some financial calculations in financial indicators at the end of year 12. Guys, thanks for listening to our video. By the time you turn this video off, hopefully you have been able to identify the 4 learning intentions and say that you have understood how to define revenue and expenses. You can identify transactions that have revenue and expenses in them. You understand there is a difference between cash and profit, and you are getting better or understanding how you might prepare an income statement. Now comes the hard work to use this video to update your notes, to do lots of textbook exercises, so you can then leave this Chapter 8 unit achieving the success criteria because you have completed income statements, you have transferred profit or loss to the balance sheet, and you can analyze business profitability by reviewing an income statement. Look forward to seeing you guys for the next video, which will cover Chapter 9.